Over the past few years, the arrival of artificial intelligence has triggered the fastest tech gold rush in history, igniting entirely new infrastructure layers, application ecosystems, and user bases practically overnight. To see the sheer pace of this acceleration, look at how quickly these companies reach centaur status, meaning $100 million in annual recurring revenue. Traditional cloud companies took an average of 7.5 years to hit that milestone. Breakout AI startups are hitting it in 5.7 years, or even less. However, looking strictly at top-line revenue ignores the question of durability. While these startups add millions in record time, many are finding that the customers they fight to acquire leave almost as quickly as they arrive. This creates the risk of burning through your TAM, the total addressable market. Scaling to $100 million in a year is a significant milestone, but it becomes impossible to sustain if a massive chunk of the install base walks out the door each month. Gaining users at record speeds is a hollow victory if they bleed out just as fast. To diagnose the problem, we have to look at net revenue retention, or NRR. This metric tracks how much recurring revenue a company keeps and expands from its existing customers over time. In the traditional B2B software space, top-tier performers consistently maintain an NRR of around 120%. Now, compare that to the current wave of AI-native applications. Across the board, their median net revenue retention sits at just 48%. When an industry loses over half of its recurring value every year, it's a sustainable ecosystem. For software companies that fail to pivot, this combination of high acquisition costs and low retention is creating a mass extinction moment. The data reveals a clear pattern driving this drain on revenue. The monthly price of an AI product acts as a direct predictor of how quickly its users will cancel their subscription. At the very bottom of the market, applications charging their users under $50 a month, retention drops to a devastating 32%. This bottom tier is populated by the AI tourist. These are consumers and small businesses buying software purely out of curiosity. They sign up, experiment with the tool's capabilities for a few weeks, and cancel once they've exhausted the novelty. This churn is compounded by the wrapper curse. Driven by trends like vibe coding, where founders can generate applications using natural language prompts, the market has been flooded with thin, lightweight interfaces layered over general-purpose language models. They are simple to build and easily duplicated. When software removes the friction from the building and buying process, it simultaneously removes the friction from leaving. It is as easy to cancel as it is to purchase. But there is a deeper mechanical conflict causing this revenue drain. AI is an autonomous system that actively overwrites the manual human workflows older software relied on to function. For the last decade, traditional software companies built their billing infrastructure around a specific mechanism, generating revenue by charging a flat monthly fee for every individual human seat. AI tools, however, are designed to execute tasks with minimal human input. Their primary value proposition is cutting costs and reducing headcount by automating the manual work those human operators used to do. This creates a paradox. If your company deploys an AI agent that successfully replaces the daily work of 10 human analysts, charging on a per-seat basis means you have effectively eliminated 9 of your own paying licenses. The standard per-seat billing model was built for a world of human operators. In an era of autonomous agents, that same model now punishes software companies for making their products more efficient. There is a survival threshold hidden in the retention data. When AI products move upmarket and charge more than $250 a month, their net revenue retention dramatically stabilizes around 85%, matching the stickiness of traditional B2B software. To reach that tier and solve the per-seat paradox, top-performing companies are abandoning flat subscription models entirely. In their place, they are adopting outcome-based pricing. Instead of charging a flat monthly rate for access, they tie the cost directly to a measurable output. A company might charge a small fee only when an AI agent successfully resolves a customer support ticket. If the tool delivers nothing, the client pays nothing. This model ensures that a software provider's revenue scales in tandem with its product's efficiency. Value creation directly aligns with value capture. The second antidote targets churn by rethinking how software is implemented. Startups looking to survive are pivoting away from the self-serve monthly model, turning instead to forward-deployed engineers. These specialized engineers physically embed into a client's organization. Operating under annual contracts, they spend weeks wiring the AI models directly into the company's core data pipelines and proprietary workflows. Even the largest foundational model builders in the industry are adopting this manual, service-heavy enterprise approach to secure long-term client retention. By taking on the heavy lifting of custom integration, the smartest AI startups are choosing to trade their initial profit margins for a deep, defensible operational moat. The flashiest AI demos were effective at capturing early attention and tourist revenue. But the platforms actually surviving the churn wave are doing the quiet work of building production-ready systems that orchestrate data in the background. To survive the coming years, software providers must move from renting out tools to delivering measurable outcomes, or risk becoming obsolete.